You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody, that music can mean only one thing. It is time for Options Bootcamp, the program for you, the basic retail stock trader. Maybe you've dipped your toes in options already. Maybe you're a little scared to do so. Either way, we've got you covered. We'll be your lifeguards over here in that deep, scary options pool. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from our network upon which so many of you have been mainlining these days. Glad to see all you guys and gals flocking in over there. Remember, if you like what you hear, keep those reviews coming on your platform of choice so new folks can continue to discover. It doesn't matter where you're getting it. It could be Apple Podcasts, Google Podcasts, Podbean, our website, wherever you're getting it. Stitcher, YouTube. A lot of you liking YouTube these days. Keep those reviews, those comments coming so new folks can continue to discover and see the program. And, of course, if you have a question, like a lot of you do today, hit us up. We do love to hear from you guys. And joining me to handle your deluge of pandemic questions, the black-hatted one himself, Mr. Dan Passarelli, the founder of Market Taker Mentoring and the author of one or two options books out there. Mr. P, welcome back to the Options Bootcamp training ground, sir.
It's good to be back, Mark. We still haven't worked in that Welcome Back Cotter theme song, have we?
We're working on the licensing rights. It's very extensive negotiations out there. You wouldn't believe how much they want just to say welcome back, welcome back. It's crazy. Crazy how much. I like my other suggestion. We go for the Welcome Back Cooper. And then, we save ourselves a lot of licensing fees. It's eerily reminiscent to that song, but not quite the same. And so you're hearing something familiar, but not quite. And it saves us a lot of money. I like it. Meanwhile, let's head right on into your mail call segment.
Mail call. Time to look at questions submitted by our listeners.
So festive. I love it. I love doing this segment, particularly not that far removed from 4th of July, so I guess it's appropriate that we have that music going. And Dan, I like to kick these off with a little bit of love. We get a lot of it on this show, which is always just so endearing. You guys are the best. Literally, I've said it before. We do have the best audience on the planet. Sometimes you hear horror stories about bad comments on certain audiences or things. And even in places like YouTube, where usually the comments in general tend to be of a lower quality, shall we say, we have great people in there as well. So we have a great audience. You guys are the best. Just like our first commenter here, Christopher Lovell. Dan, this almost makes doing this show worthwhile in and of itself. This is the reason we do this show, for stuff like this. Not the praise, but the impact that it's having on people. Christopher Lovell says, I finally did it! Exclamation point. I have been listening to Options Bootcamp for a couple of months, and he puts in parentheses here, replaying the earliest episodes a few times. Well, good call there, Christopher. He goes on to write, and reading up on options trading. Finally dipped my toe in the water today with a single long in-the-money put on GE. Thank you so much for your excellent podcasts and all the help you give us noobs. You're not a noob. Don't sell yourself short there, Christopher. He goes, I can't wait to read Dan's book, Trading the Options Greeks. And so it begins, ... I love that. I love the way he ends it. Yes, this is the beginning of your options trading career there, Christopher. First off, congrats. I know it's a daunting thing to pull the trigger on that first trade. Interesting that you chose a put on GE. People usually go for a call. I think that just seems the way people think it's easier to intuitively wrap your head around a call and the stock going up than a put and the stock going down. For some reason, that seems to be the way people like to gravitate. But hey, I hope it worked out. I haven't checked in GE in a while. The market's been rallying a bit, so maybe not so much on the put, though GE's been kind of topsy-turvy. I forgot when this comment came in, but it has been a little bit tumultuous, shall we say, over the past month. Maybe he bought it at the high there when it was 7.14, and now it's 7.04, in which case, hopefully he did all right. Let us know how that first trade did. You know, long premium trades, they sometimes can be hard to work out, like we've said, and make work out. Like we said before, there's a death of 1,000 cuts. So you have to have your set parameters in place on when you're going to kind of cut your losses, when you're going to take it off. That always helps. And then when you evolve and graduate to spreads, it'll make things a little bit easier. And we'll go on from there. But again, congratulations. Stuff like this, helping people get started with options and doing it in a safe and satisfactory way. That's really the reason that this show exists. Dan, would you concur with that?
Yeah, it really is. You know, like I love doing this show, and you're right. It is a really great audience. You know, people post really nice comments, and it's great. And congratulations, also, man. Like, congratulations, Christopher, making that first trade, getting one down. That's awesome. And good place to start too. You know, just buying an in the money call or a put. You're not going to want to do that forever. You're going to want to move into spreads, but that's a great place to start because it's fairly easy to understand, just almost like a substitute for shorting the stock with a little bit of nuance to it. But yeah, great job, man. Keep it up and keep it up.
All right, Dan, hope you got more ready for more love because we got more coming. And it's an epic one with a good question at the end too. This next one comes from Theodore Domzalski. If I butchered your name, I apologize there, Theodore. He says, I love the show. You guys are doing a great service to us retail customers. Well, thank you. Again, you guys are the reason this exists. We keep this show. You guys, even when we put it on hiatus, you guys are hitting us up saying, bring it back, please. So we're putting it out there, bringing it back, keeping it out there on the regular weekly rotation for you guys, particularly in these mad times. You can use a little dose of sanity. He goes on to write, my question is, if you have a long call spread and get early assigned on the short leg, can you close the short stock position the same day if you don't have the buying power? I know you'll receive the money for the stock, but is that considered unsettled funds? I sat up last night chewing Tums, oh no, and staring at the ceiling. Thanks again. Sorry if this was specifically covered on another show. I closed my spreads out early due to the fear of the unknown. Maybe I should only be doing them on underlyings that I can afford 100 shares of. Thanks. Look forward to hearing the next show. And he adds a little caveat here afterwards. I've been listening for 6 months now. I love the lineup. I love the knowledge. If you wish to make my story more personal, here's the data on my trade. I did my first trade on Amazon. It was a bull call spread, a very tight one with a delta of about 3. That is very tight. Amazon rallied through both strikes. I know that's what you want to happen, but then I am staring at the ceiling wondering what assignment would look like. As the thought of being short 100 shares of Amazon and 300,000 on the line, I closed the position at 10 a.m. I would have done it sooner, but who can tell what's going on with that wild ride? Later on, I called my broker. I won't say which one he uses. They assured me they would always let the customer exercise the long call. Logically, there was still 10,000 of extrinsic value in the short call. I kept asking myself, am I going to have to try to borrow $300K to cover the short stock position? Mark Longo and Dan Passarelli have been inspirational to my education on options. Wow. I bit off more than I could stomach with Amazon. One more question. Okay, we'll allow it because you're so nice. No matter how crazy assignment gets, are you still only on the hook for max loss on the position? Mine was about a dime. Thanks again. Keep teaching. I love the show and love being in the loop. Rage on and let the force be with Mark, and praise to the Sith Lord Dan, the dark-hatted one. Wow, that was an epic treatise here. Let's try to parse it a little bit. Early exercise and assignment, Dan, does seem to give people the willies out there these days. We covered it before on that very tragic story with Robin Hood, and check out that episode if you missed it, listeners. We kind of went through a specific example of why that early exercise isn't actually an assignment, isn't the worst thing. out there. And remember, in this scenario as well, it's not the worst thing. He mentioned there is still some extrinsic value on that short option. So if someone is exercising that early, you're getting that value. You're getting that option without the extrinsic value. You're getting only intrinsic value. So that's why there's never really, outside of capturing a dividend, there never really is an economic reason to exercise your options early. It just doesn't make sense. You're giving away that premium. You're better off selling it in the marketplace and getting all of the intrinsic value plus the extrinsic value. So in that scenario, that's like we said when we had other guests on talking about this topic in the past, it's usually a win for you. In this case, you have that in-the-money call against it. So unless your broker is insane, they should hopefully see that and not they're not going to, unless you're using some broker that really has no business handling options, they will see you have an in-the-money call and then a farther out-of-the-money call against it. So you therefore are hedged. And so your loss is limited to that spread you put on there. Dan, any thoughts on this scenario of getting assigned early on a tight vertical where you break through both strikes? And then B, what about his suggestion that maybe he should migrate his flow to an underlying where you can handle picking up 100 shares as opposed to Amazon? A lot to parse here.
Yeah, I mean, I'm listening to this exact, specific example here, and I mean, I think the best advice that I could give is if you think about that spread. It's a bull call spread. Both options are in the money, so the stock is above both strike prices. How much can that spread be worth? I mean, if you're buying like the 60, well, I guess it must be some, he did say, Amazon, right. Yeah, if you're buying like the 30.85 calls and selling the 30.95 calls, like that spread can only be worth $10. If it gets to be worth $10, you win. It's like you cross the finish line, stop running. That's it. And if both options are so in the money that even the short strike, which is the closer to the money one, is getting assigned, you already, you shouldn't have that trade on anymore. Take it off, even if you have to sell it at $9.90, that's fine. I love leaving money on the table because the times you don't can be a disaster if it reverses and a great winner becomes a horrible loser. So take the trade off. You've got no business even getting assigned because good management dictates take your profit.
Yeah, this is another scenario where people get worried really for no reason. This is as you mentioned in your email, this is a win. If you're sounds like you're uncomfortable with the underlying, so I think that would definitely be a recommendation, is switch to something. Doesn't mean you have to go trade Ford that's $6, but something that's not $2,000, because it sounds like this is giving you heartburn on this name. So move away. Maybe again, you're new too, so maybe you want to try a little bit less volatile underlying to kind of get your options trading legs under you a little bit before you dive into the madness, the maelstrom that is the Amazons and the Teslas and all the other crazy fun names that everybody likes, but they come commensurate with a certain level of volatility, and that could be a lot for some people, and particularly if you're blowing through strikes like crazier. But yeah, you won. That's a good thing. Sleep well at night. You have the other call against it. And like Dan said, take it off. If you go that far in, at a certain point, you're waiting for what? You're waiting for a couple of extra cents to come your way for that spread to widen out a little bit. At that point, just take it off. Move on to the next trade, particularly if it's causing you to lose sleep at night. Then definitely. That's a good barometer. If a trade's causing you to lose sleep, take it off. There is all sorts of unintended and unpriced consequences from risk, and one of them is, the impact it has on your life. And if it's having a negative impact on your life, take it off. Put a different trade on. Live to trade another day, and your non-trading spouse, whoever else is in there in your family, will probably thank you for that as well. You'll be a lot less stressed. All right, let's see. Belzer's got a lot of epic treatises on the show today, Dan. I love the folks hitting us up. Keep it coming out here. Belzer says, hi. Hello, Belzer. He says, I've been playing options for a while. I'm assuming that's a typo. Unless he's paper trading, but I think he added playing by accident. I'm going to say, I've been trading options for a while now, and I have a basic understanding of the Greeks. Here's my approach. When I buy a call option, I think to myself, do I believe that this stock can reach the break-even price before the expiration date? If my level of confidence is high, I tend to purchase it. Theta doesn't even matter in this case. I just care about whether it'll reach the strike and I'll make the profit. Is that the right way to approach the trade? Or should I be factoring in theta into those positions to improve my returns? Or what role should delta play in my analysis? And if I think a stock can make a particular strike by expiration, then am I better off picking a few higher probability but more expensive calls or more lower delta calls to maximize my gains? Oh, there's a lot to unpack. This kind of gets back to one of our earlier conversations, Dan, where people had suggested, in one of our, I think even our guests on the network had suggested that the Greeks in this scenario are kind of meaningless. And he kind of maybe agrees with this listener that, you see your strike, and as long as you get there, you're good. I've always taken a bit of the counterpoint, and I'm sure you will as well, as someone who's written the book on the Greeks, that, the Greeks, it matters how you get to that strike, and that's where theta plays a role. I've said it before. I said it just a recent episode here. I'll say it again. If you buy premium, you need that move to happen relatively fast. The notion that you're buying a 30 or 60-day option, so you have 30 or 60 days for that trade to play out. Technically, it's true. Practically, in reality, by the time you get most of the way towards that expiration, that option is going to have eroded to the point where it's effectively worthless. And now you have a very different scenario. You have effectively a worthless lottery ticket on your hands versus that something that had some value when you first put it on. So you want that move, that development, that trade to happen when that trade still has some life in it. So you can get that meat in the bones, get it, make your money, take it off, move on to the next thing. If your trade erodes all the way down to a couple of cents, and then you're just sitting there hoping beyond hope, you've already lost all your money, and you're hoping, man, I hope I make my strike by expiration. That's not the scenario you want to be in. So in that case, it does matter quite a bit about the theta and how quickly you think this move is going to happen. That's the part of the scenario people always forget. They look at the expiration graph type of options education. They say, oh, here's my break even and my max loss. I need to be here by expiration, therefore it should work. But in reality, how quickly you get there is a big factor in that. Dan, what do you have to say here for Belzer and his thoughts that the theta doesn't matter, and also does delta matter, and if so, how should he use it?
Yeah, I would say in the last 6 months, I might have held one option trade until expiration. I almost never do. And so, looking at that hockey stick at expiration P&L diagram, it's useful so that you know your maximum loss and, break even and maximum gain and all that. But good management dictates you take stuff off before expiration. So you're never actually going to see that. So just looking at that P&L diagram and looking at the break even, I don't know, I feel like that's not the most important part of the story. And if you are going to take a trade off before expiration, which I highly encourage you to, then you need to think about your timing, and just like Mark said. And so how long do I plan on holding this trade? Is it for a week, or is it for a day, or is it for a month? Theta really comes into play. And to be fair, if you are holding it all the way until expiration, what I call aggregate theta, which is basically a different way of thinking about the extrinsic value of an option, that aggregate theta, the total theta between now and expiration, which is your option premium, you want that to be small because your break even's better. So you do still care about it, even if you don't think you do, whether you're holding it until expiration or not. So it's definitely still important, but think, just kind of think it through and look at the option premium and think about how that would change your at expiration break even. Think about how long you plan on holding it, because I see the next part of this question has to do with delta. What you make on delta, if that's offset by theta, that doesn't help you.
What about the little tertiary part there where he asks, should he focus instead on loading up on some more kind of lottery ticket type options that are closer to the strike, but he can buy a lot more of them so he can maximize his leverage there? Or should he pick what he terms higher probability but more expensive, kind of more in the money type calls? Dan, where do you fall on that approach?
Well, the thing is, the reason why there are so many different option strikes and expirations is because they all do different things. There's there's not a single right answer to this. It depends on what you're trying to accomplish. It depends on what your forecast is. If you're looking for like a big violent breakout to the upside, you're always better buying those cheapo little delta lottery ticket options. Like you lose less and it can explode in your favor and have a hugely leveraged profit. If you're looking for like a slow trend up, you're better off buying an in the money call, because there's, again, less theta and bigger deltas, so you participate more on a tick per tick basis. So like it really depends. It really depends on your forecast and your objective for the trade. Like the best traders craft an option position around their forecast, so that they give themselves the least risk and the greatest reward and the best chances for what they're trying to accomplish. Craft the strategy, craft the trade around your forecast, and that can be a really, really powerful thing for you.
I almost wish we could move options education away from the break-even graphs. I know they have a role, they have a purpose, and it helps simplify the concepts. I understand that, but it seems like that's such a limiting way to explain options. When people then all they think of it is that. They think, I need to get here by the expiration. That's all that matters, when there's so much more involved in how you get there and when that occurs and what happens in between. In fact, I would say the lion's share of options trading is what happens in between. And so it's a very limiting approach. Just think of it purely from a straight P&L, or I should say a straight profit and loss graph perspective. All right, we got to keep on rolling there. Great question so far. Mac's chiming in. Mac wants to know, hey guys, love the show. But we love you, Mac, right back at you. He says, thoughts on the options upgrades that Robinhood is making. Are they sufficient? Do you think they'll be enough to prevent another tragedy from occurring on their platform? I'm not sure if we broke it down on the recent episode where we talked about this tragedy in particular, what the upgrades are that they're making, but we'll list a few of them here. They say they're adding more criteria and education for investors seeking level 3 options authorization to, quote, help ensure customers understand more sophisticated options trading, end quote. Well, that's probably a good thing. Maybe you could argue they should have done that before. They say more education around options trading, including some about early options assignments, and the planned hiring of an options education specialist. They've also changing their messaging and emails to clients about their, quote, multi-leg option spreads. And they're adding details to their in-app history page to help users understand the mechanics of early options assignments. And they're working on changes to their UI, including the way buying power is displayed. So I think you could argue, all of this stuff should have been in place from the beginning, from jump. If you're going to offer options trading, you need to have this stuff kind of baked in. You can't scare people with random, kind of almost meaningless and completely nonsensical, in this case, type warnings that this guy owes you $750,000 when it's clear that he does not. So that probably should have been in place earlier. And this is, unfortunately, the growing pains of a new broker coming into options for the first time. I should note that we have reached out to Robinhood. They have reached out to us in the past about coming on. We reached out to them recently in the wake of all of this, and they kind of have demurred a little bit. So we have given them the opportunity to come on the network and explain all this themselves. They haven't opted to take it. So we don't know exactly how all this is playing. I should mention as well, I've used a lot of different brokerage platforms. I have not used the Robinhood options offering yet, so I can't speak from experience as to its efficacy. But if it's missing a lot of these basic core functions, I'm going to guess it probably isn't the best. People get lured in by low cost. Low cost also, unfortunately, might mean you're missing out on a lot of the core functionality you come to expect from a quote-unquote traditional options broker that provides these types of UI things, so you know what these alerts actually mean, and they have better criteria. The criteria on level 3 options, that one stands out to me a little bit, because I kind of thought that was fairly standard amongst the brokers. I need to reach out to like OCC or others and see, is there room for brokers to add their own layers to that? If that's the case, that's kind of interesting. And I would like to know more about how much wiggle room they have there. Because I kind of thought going in, level 3 was clearly defined, level 2 was clearly defined, level 1 was clearly defined. And yet it sounds like here they have some wiggle room to adjust that, which is a little bit surprising to me. Of course, I mentioned earlier I was helping some people do some tax day stuff recently and setting up IRAs and all that kind of fun stuff. And I was surprised. I haven't done it in a little while, applying for level 1, 2, or 3. Just how easy. It's effectively just checking a box. And you can get level 3 on just about anything these days. So that's maybe somewhere where the industry needs to push back a little bit and say, you know what, you should really understand what the heck you're doing before you get into these types of spreads. Because as we all saw very clearly, this could have tragic consequences. Dan, do you have any familiarity? Maybe some of your clients have come to you using this platform. Have you heard any interesting things about it? A, and then B, what do you have to say about Mac's question? Do you think these improvements are going to be enough, sir?
I don't know. I mean, we'll have to see. It's all in the execution, they can do it right or they can do it wrong. And we're just going to have to see how it goes. I mean, I think I said on a previous show, like early on, I contacted Robinhood a couple of years ago, I guess. And I was like, hey, you have options. Like, I don't see anything on your website for education. Like, I mean, don't you think it's a good idea to educate your customers? And, they didn't even email me back, so, I mean, I don't know. You can only, you can't even lead a horse to water sometimes, but, I mean, it's sad that it took such a profound thing to open their eyes up to something that's so completely obvious to do,
Yeah, it's a shame. You're right. It shouldn't take a tragedy. And just to give you a little behind the scenes glimpse here, they have reached out to us multiple times about coming on the network, and whenever we say, okay, sure, you can come on, at the last minute, something has always happened to cause them to not want to come on. So it happened a number of times now. This is just the most recent example of that. So that kind of always gave me pause that maybe options weren't first and foremost in their mind out there. But hey, we like to see brokers making these changes. Again, it's a shame that it took a tragedy to have this happen, but hopefully this will prevent such things going forward. I think they could probably do more as well to make their platform as robust as some of the other options platforms out there. All right, we got time for maybe one more here. Let's see. Where should we go? Here's a interesting kind of thought question. Let's go over this one. TLCI. Tilkey wants to know, what is the farthest out you recommend trading options? That's an interesting question because we see, particularly on the equity side of the fence, so much of the liquidity, so much of the order flow these days is aggregated sub 30 days. People are playing in the weeklies for size out there. That's kind of where everyone likes to play. They like short duration. Getting back to our theta discussion earlier, people like to harvest that theta, and so they like to sell it. Also, weeklies are cheap, so they can buy them to hedge around specific events. So weeklies, that's where the action is in most of the equities, and indeed most of the major indices out there. But now you raise an interesting question. How far out do you want? It kind of depends what you want to do, right? If you want to harvest premium, you don't want to go out that far because you want to capture all that theta. Hence our discussion from 30 seconds ago. If you want to hedge, maybe you can have an argument for a little bit longer term. If you want to do stock substitution, also an argument for a little bit longer term, at least 6 months out there. So it kind of depends what you're looking to do, which is what makes this an interesting thought question. Dan, in general, looking back at all the clients you've dealt with and mentored over the course of the past decade plus over there in Market Taker, what's in your memory the farthest out you've had someone or trade or put something on?
Oh, we have some people who are big with diagonals, but they buy some leaps and they sell, weeklies against them. It goes across the whole spectrum, really. There's two factors here. Objective and liquidity. And the most important factor is objective, similar to the last answer I gave, what are you trying to accomplish? If you want a long-term play with a built-in leverage and safety, buying a 6-month option that's deep in the money, might make a whole bunch of sense. Buying a weekly option and then letting it expire and buying another weekly option would be a silly way to handle it. So your objective is a big driver of that decision. And then the other factor is liquidity, just kind of piggybacking on what you were saying, when bid-ask spreads are super wide, that's no good. You're just leaving too much on the table there. So you really want to be trading those tighter markets, which, like you said, Mark, they're usually within 30 days.
Unfortunately, that music means we've come to the end. Interesting discussion, great questions even there at the end. You had just so much to parse there. People like different use cases, like you said, Dan. Our friends over there at Swan on our Advisors Options Show, they love to buy 2-year out leap puts to hedge their S&P exposure, and then they roll it at 1 year. So again, it depends, like Dan said, your objective. Of course, the farther out you go along that time frame, listeners, the wider those markets are going to get. So bear that in mind as you're getting farther out there. But it sounds like from what we've interacted with you guys, the lion's share of you are coming in the front month, or the front 3 definitely out there. But yeah, interesting thought question. Technically, you can go out as far as you want. You can do a flex now. I think the minimum for a flex is 1 contract over there at SIBO and others. So you can do it's not exclusively the domain of the large institutions. You can do a 1-lot flex if you so. So if you want a 10+ year option on something, someone will quote it for you. It'll be crazy wide, but they will quote it. So if you want to do a 1-lot out there, it is possible. So theoretically, I guess there really is no limit, but practically, what we just said, I think, is applicable for most of you out there. All right, Dan, that music, unfortunately, we can answer questions for hours. We got lots of you chiming in. We'll get to more of you. Don't you worry. Keep them coming. But Dan, if folks are intrigued by what you're talking about here, and maybe they want to hit you up with some questions or comments here, where should they go? What should they do?
Yes, surf on over to markettaker.com, 2 T's in a row. Market like stock market, taker like take something that's yours. And visit us at markettaker.com, and happy to chat with you. Hit the contact us form, and glad to answer any questions I can offline, and glad to help any way I can.
Yes, and some people have written in, they have specific problems, they want someone to help, like a listener here in our notes, and I won't read their name. But I have sent them over your way, Dan, to chat with you about some specifics, so hit them up, Market Taker, 2 T's, in between episodes out there. And we'll keep these coming. We'll keep cranking away on Options Bootcamp. So you guys out there, keep those questions coming. If you have an idea for a topic you'd like us to discuss on the show, hey, I'd like you to revisit this. Make sure you check our archives first. There's a good chance we probably have touched on it. But if we haven't, or maybe you think it's worth revisiting through a certain lens, hit us up. We love those kinds of suggestions because it makes us maybe think of a certain topic in a different way that we haven't thought of it before, and it might be informative for our audience out there as a result. So keep those questions, keep those comments, keep those reviews coming in your platform of choice, and we'll see you back here next time for more Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.